Everybody. This is Cynthia Hurley with the Make Sense with Your Money radio show. And I have with me, I'm excited to have my guest this evening, who is Mr. Pernan Dunstan, who is a financial expert. And tonight we are going to be continuing our series about the wealth of life insurance. This is a series. We did one series last week. This is series two. I would advise you to check out series part one because it was very juicy, very informational. I find that a lot of people are, what can I say, they're very misinformed about life insurance and the benefits of life insurance. So we have agreed to do this show, this series, to make our community more informed, if you will. Thank you so much for tuning in Instagram. We appreciate you. So, Pranon, can you tell our audience a little bit about yourself?
Well, thanks again for inviting me, on your platform. I'm Pernan Dunstan. I am CEO of Golden Life Group. Started the insurance business when I was 17 years old, worked with my father, Sam Dunstan. He started a national allotment insurance agency in Brooklyn, New York. So pretty much I have a background of the insurance business, working with my father. That's how I got into the business. That's what taught me most things that I know. We focus on legacy planning. We focus on whole life insurance, annuities, pretty much life insurance that's building wealth in life and in death, of course. We don't focus too much on the death part because that's a given with life insurance. We focus more on how you can use the policy while you're alive. How do you make use of your cash value? How you make use of tax shelters with the life insurance policy? So that's what we're here today to talk about. So I know you have a few questions for me, and I'm ready and willing to answer all of them.
Okay, do you have your mic on?
I don't. Yeah.
Oh, I'm sorry,
It's
y'all.
okay. It's
We
okay.
go to we were doing some testing before we came on
I
live,
did.
and I didn't even put my mic on. So hopefully you can hear that you can hear everything. And if you can't, somebody will shoot a message. Okay, so thank you so much for tuning in. You can share, you can like, to share the video so that more people can tune in because this information is very important. Okay, so where do we start? Where do we start? Well, tonight I want to start off by talking about the different types of life insurance. There are many types of life insurance, and when I talk to people about insurance, of course they don't know. I wouldn't expect them to know, especially if it's not your area of expertise. It's just like somebody speaking Spanish or French to me, and I'm English, and I don't understand the language. So that's okay. But I encourage those who are in need of, those who have a family, and even single people, depending on who you may take care of somebody. But anyway, it's important to know the types of life insurance that's in the market. We have whole life insurance, we have what's called term insurance, we have final expense. Now, you have the different types because you have life. I'm sorry, you have term, you have whole life,
You have universal life.
and you have
Universal.
universal life, and you have
Right.
variable and variable
Variable
life.
UL.
UL,
Yes,
right?
form of
Universal.
UL. Yeah.
So all of these different types of insurance, uh, they just have different features, if you will. And I think we kind of touched on it last week.
Yes. Well, yeah, we did.
And in terms of what whole life is. So what is whole life, Pernon?
So I'm simplifying it. Whole life is a permanent death benefit coverage, permanent cash value building. So your cash value is going to grow no matter what. Your death benefit will be there no matter what. As long as the premium is paid, your coverage will cover you for the rest of your life, and your cash value will definitely grow for the rest of your life. It's all guaranteed features. Whatever that benefit is, that's what it will be for the rest of your life. Whatever the cash value would be in the illustration, that's what you're going to you're going to receive that in life. So it's all guaranteed features. No matter what the market does, no matter what even the company does, you still guaranteed those features. Death benefit is permanent, and the cash value is permanent
I'm
to
glad.
grow.
I'm glad you talked about the market. But anyway,
Yeah.
go ahead. I'm sorry, I didn't interrupt
That's
you.
what that's cool. So the term insurance, you have a 10-year term, a 15-year term, you have a 20-year term, you have a 30-year term. So you have to die within that time period to get the death benefit to your beneficiaries. So if you have a 30-year term policy and you die a day after 30 years, your family won't get anything, and the company will keep all that money. So there won't be a return of premium. There won't be a small death benefit. It'll be absolutely nothing that would go to your beneficiary if you die outside of that time period.
Mm-hmm.
So, I mean, term insurance is useful in some cases, but there's things you can do that is a little better than term insurance. Sometimes, what we do for our clients, if a client can't really afford the target death benefit they want with a whole life policy, I would normally do a whole life policy with a term rider with a package with the policy, so to make it affordable for the person, but they could also have that target death benefit that they want. So I don't have to put the client in 100% term policy because they can't afford a whole life policy.
Mm-hmm.
I just make it affordable to them by mixing the whole life and term together. So pretty much term insurance covers you for a certain period of time. If they die within that time period, you get your death benefit. There's no cash value accumulation at all. There's no money you can pull off the policy. There's no tax shelter. It's just death benefit for that time period.
I like to I like to liken term insurance to car insurance. Because
Right,
term car
yeah.
insurance, you have car insurance for a term, 6 months, right? For a year, however they break it
Right.
up. You pay it, you have it. You don't pay it, you don't have it. Period. That's
Right.
so, to simplify it. And he did simplify it, but sometimes, you gotta go extra mile.
Right.
I'm gonna go the extra mile when I'm talking to
No, that's cool. I mean,
car
yeah,
insurance.
yeah. Well, car insurance. Like I normally use car insurance as an example when I'm doing my presentations because someone will often say, if I buy this whole life policy, if I want to cancel it after 2 years, do I get my money back? So I say, well, the company, agreed to cover you for 2 years. So if you would have passed
Mhm.
away within that 2 years, the death benefit would have paid out to your beneficiary. Now we go to car insurance. You can get into a car accident, your price is going to go up.
Mm.
If you don't get into a car accident, your price still may go up, but you're going to be paying that premium for the rest of your life as long as you have a car,
Exactly.
and you can't pull any money out of it. You can't borrow from it. It's not a tax shelter. It's just
And
to
you can't get your money back.
right. And if you get into a car accident again, your premium's going to go up. So that's worse than I think a whole life policy, but
Absolutely.
it's necessary in the state that we live in. We have to have car insurance, so it's a law. So you have to abide by the law, But
Mhm.
that's something I sometimes say that like if someone tells me if I buy this insurance policy from you, I want to cancel it in 2 years so I get my money back. I mean, with car insurance, you're not gonna get your money back,
No.
So why should life insurance be any different?
Why should it be any different?
I mean, keep it for 5 years and then cash surrender it, and then you get some of your money back. You get the value of the policy back. Still better than car insurance as far as the features go. So, yeah, to answer your questions, when it comes to car insurance, yeah, I mean, you're pretty much paying for accidents that happen. But if you don't get into an accident, your money is still gone. It's still spent. So,
That's
yeah,
right.
yeah, it can't be compared to whole life insurance at all. There's no comparison.
Okay. Okay. So, you know, uh, you when you get in life insurance, you're not only protecting your life, but also your assets. Some people feel that they don't need life insurance. Well, in some circumstances, if it's just you, maybe not. But what do you say to somebody who say, "Well, I don't need life insurance"? I guess it depends on who it is.
All right. So let's say for the 25-year-old to 30-year-old, single, not married, no kids. Why do I need life insurance? I don't need life insurance. Who am I losing money to? Again, let's not think about death benefit when it comes to whole life insurance. Let's not even think about death benefit. Let's think about the tax shelter feature of it. And what is tax shelter? Exactly how it sounds. It's a feature, right? That you put money in. Like, okay, it's a shelter. Tax shelter is a shelter that you put your money in, and the IRS cannot tax you on it. So while the money is going into that shelter, IRS cannot tax you on that money, and you can pull money out of it and not be taxed on. The reason why you can pull money out of it and not be taxed on is because it's considered to be a loan from your death benefit.
Mhm.
That feature is there to protect you from being taxed on. So you want to have a whole life policy so you can put money into the policy and pull money out of it and use it as a bank. That's what we call the banking yourself concept. So for a person between the age of 25 years old and 30 years old, I would say buy a whole life policy so that way you can create your own bank and you can now tap into your own policy to use money to invest and things like that. Instead of going to the bank to get a loan, you go to your policy and get a loan.
Get a loan.
And there's nothing wrong with buying policies on other people. You should buy a policy on your mom, your dad, your brother, your siblings, because each policy you own, even though it's on other people's lives, each policy is building cash value. They're each building their own bank. So the more policies you have, the more money is being grown within the cash value, even for yourself. But some people say, well, I have a policy with you. Can I increase the policy? So when I increase it for them, they get a whole new policy. So they say, well, why is it not attached to my old policy? Why is it not just with that same policy number? Well, when you're increasing a policy, you can only buy a new policy. It's like building a house brick by brick. Each brick represents an insurance policy. Each brick represents your cash value, which is your bank. So when you increase your policy, you want to buy another policy because now that's another set of interest growing on the money you're putting into that policy. So you have one policy on yourself, one policy on your sibling, one policy on your parents. Each policy is growing cash value, and each policy you could tap into and use however you wish.
Okay.
Cash value, of course.
Right.
You know, again, we're not talking about death.
Right.
Because death is sad. We don't want
nobody don't want to talk about.
We don't want nobody to die. No, we don't. I mean, I don't want nobody to die. I want you to use your policies while you're living.
Exactly.
That's
but people
don't.
They don't look at life insurance, and that's why we're doing this series, because we want you to have a whole new mindset when it comes to life insurance. People look at life insurance because they planning their own death, but we're coming at it from a different perspective, where you can look at it from a life perspective, from a wealth perspective, from a transfer and generate, using it for your benefit. There's benefits to life insurance that you don't have to use necessarily after you're not here, after you're dead and gone. It can be used for yourself, actually, right? That's what you just explained.
Yeah, you become your own bank. You have access to money. You have access to money that you can use however you want to use it.
Right.
You don't have to give me no reason why you need the money. You say, listen, I want XYZ sent to me in 5 to 10 business days, and it's sent to you. There's no reason you get the calls for the reason to get your money out your policy. You just request it. That's it.
And it's interesting because, and I have two things. I got to write it down so I'll make sure I don't forget. But I want to talk about, and I think I mentioned this on the last show, is that McDonald's got started, and I'm going to keep reiterating that. McDonald's, the company McDonald's, many of you should know the history, the Ray Kroc brothers got started because the banks, they would not fund them. The banks would not loan them money to start McDonald's. So they went into their policy to get a loan to start their business. Same thing with Walt Disney. If you read the founder, I forgot his name anyway. If you read his book, he'll tell you that he got started by pulling money out of his life insurance policy. That's how he was able to start Walt Disney. I don't need to go any further than that. All right. Number two, it's interesting now when you go to the bank, and I know many of you, well, I'm not going to say many of you because I don't know if many of you have ever went to the bank and tried to take out a lump sum of money. But when you go to the bank and you try to take out a lump sum of money, like say over $10,000, and this just happened recently, they'll tell you, oh, call maybe 2 days in advance because they need to make sure they have the money to give you.
Well, I mean, you're taxed on it too.
Yeah, but and then they start reporting you to the INS, and not only that, they question you because they want to know if there's some terrorist activities going on. You know, you got all of this stuff going on in the world right now, so it's not, and that's a whole nother show because I'm not really gonna get into that now. But you can't, and now mind you, this was not no small bank. You walk in and say, listen, I need to take out $10,000. No, next time I need you to call 2 days in advance. This is what the bank said, because they want to make sure that they have that money on hand. Think about that. Why did I go there? I went there. I'm blowing. No, I went there.
You're flowing.
I went there because you need to be able to have access to your money without being questioned.
Right. Yeah. That's the.
You need to be able to have access to your money without filling out forms and all of that. What you doing with this money? Oh, you got to pay taxes on this. Okay. Even when you want to get your 401k, you got to get money out.
You're taxed on it and you're penalized if you take it out too soon.
You tax and you penalize. I just gave an example. I think I was just talking about this. I don't know if I was talking to you or somebody else. Somebody that I know left their job. He left his job, right? A client of mine, and he he wanted to take out his money. So what happened was he needed to get access to his money. So of course he's not retirement age. He's like 10 years away from being retirement age. I think like maybe 5, 6, close to 10 years. Anyway, they took half. He was penalized to the point where they took half of his money.
That sounds right. Yeah.
They took half of his money. He had
right.
like almost 100,000, almost 50. Almost 50. That's a lot of money that he got penalized and it went straight to IRS. You don't see that money.
Yeah.
You don't see it.
Yeah.
So we have to, and it's not even all about, I don't care if you black, white, purple. If you need education about your finances, you need education about your finances because money don't have no color, it's just green. You understand what I'm saying? So we have to become more financially aware, enlightened about finances. That's the whole point that we're trying to get across here. We want to enlighten you on how to be more fiscally wise, intelligent about your money and the strategies on what you can do, when it comes to your finances. And life insurance is just one of the ways that we're going to bring this knowledge to you. Okay. So the second thing I want to talk about, right? I want to talk about, because a lot of people, some of the questions that I get is, oh, well, I may not qualify because of health conditions, or, I had this in the past. I don't know if they're going to come. Let people know that sometimes, well, people who may have health challenges are insurable. It depends on some of the conditions, but they are able to get insurance, right?
Well, I mean, with us.
Okay.
With
us.
Yeah,
with us.
With our general agency, without brokerage, we can get them coverage.
Okay.
But normally, no, they're not able to get coverage because that's the process of elimination. Because
process of elimination.
Yeah,
okay.
Like they don't want everybody having this way of saving money, this way of having access to money. This is not what you see on what we sell, what we offer, what we educate. It's not on a billboard. It's not on TV. This information that's not privy to just anybody. You have to really be, knowledgeable about it and get the information from the person who's knowledgeable on it and willing to share it with you.
And not willing to just make a commission.
Right.
It's not about making a commission. It's about it's about really educating the client, which is you, on what it is that you're getting. Right. Most agents don't do that.
No, it's about how much commission they're going to make. So they'll give you a product that is going to give them more commission. But how would you know? You're not in the business. Exactly. You think they're giving you the best product because they're smiling at you. But at the end of the day, they're giving you a product that's probably giving them more commission. Mm-hmm. They can give you a different product, but they might get less commission on it.
Mm-hmm.
So we don't do things like that. We're conscious led. So We're gonna give the client what they need and what they want. Mm-hmm. They may not know what they want because they're not educated to it yet. So we're gonna hear the client out, see what their needs are, what their future plans are, what their goals are, and then we structure a policy according to what they're trying to accomplish in life.
Which is important.
Right. So if they are, let's say if they work for corrections and they make $200,000 a year, so they should get a whole life policy. They should get particularly a 10-pay policy where they can start paying this policy and they paid off for 10 years and have access to money when they want to buy their house. So instead of going to a bank to get a mortgage, they can pull money out their policy and buy their house. Or if they already own a house, they can pull money out their policy to renovate their house or buy the next house. So it's things like that, that we do. We hear out the person what their goals are, where they want to go in life financially. Mm-hmm. Again, the death part is already there. We're not even talking about that no more.
We're talking about the life part, y'all. We're not talking about the death.
What they can use the money, how much money they need, and how much money they're making, so they can put it away, so it's not taxed on to be used later with interest on the money that they're putting into the policy. Because you're not just giving us money and we're holding it for like a bank. You're giving us money to have a death benefit on. Secondly, that money you're giving us is growing between 6 to 8% every year, guaranteed. We can offer variable products, but I don't believe in offering variable products because variable products are based on the stock market.
It's based on the stock market,
right?
Which in this climate, I think many of you may want to, I don't know, you may want to question, That's a whole nother show, y'all. But the climate is not that great now. So you may want to, you really want to be kind of cautious as to where you put your money.
You should want guaranteed features,
Especially now in this climate.
Yeah.
Put your money in something that is going to be guaranteed.
Yeah. Everything we offer is guaranteed.
Right.
What we show you in an illustration meaning the projections of how your money is working in the insurance policy or the annuity. What we show you, that's what it's going to be.
Okay.
If it's going to be 10,000 in 5 years, that's what it'll be. If that benefit is 1 million, that's what it's going to be.
Okay. Good to know.
That's what it's going to be. Yeah.
And I'm glad that you brought that up because there are a lot of commercials all over the TV about insurance. You got the guy, I forgot his name. Is it Conseco? I forgot the name of it. But anyway, this guy, and it's interesting because marketing, if you are a marketer, if you're in the marketing business, these companies know how to market to certain communities, if you will. And one thing I'm going to say about the TV insurance, the marketing that they do on TV, because people believe that because they're not in the insurance business.
Right,
so people believe what they say. People believe what they say on these commercials. But I'm going to say this, a 30-second TV commercial is not going to give you, let me see, the knowledge. It's not going to give you the pros and cons of that in particular insurance. And you're not really going to know what you're getting. Okay. So you don't believe the hype is what I'm getting to. You cannot believe the hype. You need to be able to sit down with somebody that's going to be able to explain to you what it is that you're getting, what questions you have, what it is that you need to know about the insurance product. So a lot of people are signing up with these TV, because a lot of people are. They're calling in and they get these because they believe that if you 60 years old, you can get a policy for $9.95 a month. Right. You know what I mean?
So you know how that works, right? So
no, tell them. Tell them.
If you call in to a company that's on TV, it's $9.95 a month for $25,000 of life insurance for 65-year-olds. So once you call in and do your application over the phone, you give them your name, your social, your birthday, but with your social security number, they put it through a system called the MIB, Medical Information Bureau, which they will run your medical history. Once they see what medications you take currently or have taken in your course of your life or surgeries you had or things you've been diagnosed with, then the price triples, sometimes quadruples. And that's how they get you. So now your elderly person will already give them my information, let them pay for it. Not knowing that there's other options out there that you can get that's more affordable. That's how it works pretty much.
Don't believe the hype, y'all. Don't believe the hype. Again, you are watching Make Sense with Your Money, and we are talking about wealth insurance. That's what we're talking about. Because most people, we're talking about life insurance does have something to do with it, but it's really about wealth insurance. We coming from the other side of it. It's not just about the death benefit. We want to talk about some different strategies around life insurance. Okay, and this is the second part of a several part series that we're going to be doing, to answer some questions and to get you more enlightened on, life insurance.
So also want to add one more thing, right? So whole life is just a vehicle.
Okay.
It's just a vehicle. It's what we're trying to do here. And what we're trying to do is create wealth.
Right.
In life and in death. What product can you do that with?
Okay. That's good.
I mean, if you buy a house, you have taxes, you have insurance to pay.
Right.
So if you leave your children in a house, if they don't have access to money, how are they going to pay the water bill? How are they going to pay the mortgage?
They won't.
How are they going to pay the insurance?
They probably end up selling the property.
Right. I've seen people in Brooklyn lose their property because they didn't even know about the water bill.
Oh,
they lost their property because of the water bill.
Wow.
Lack of knowledge. I mean, the idea is to leave your kids something, but if you don't leave them with something in knowledge and access to funds, then it's all for nothing, really.
And yes, we got to start educating our children about these things. You know what I'm saying? And money can be a taboo. Well, it's a taboo to people who don't have it, or they feel uncomfortable talking about it because they feel that it makes you less than. But no, this is why you learn so that you can be able to, accumulate something. You know what I'm saying? And then teach it to your children, right? So, what do you say to? Because I run into this a lot. I don't need insurance because I have insurance on my job.
Right.
Is that one of y'all? Maybe one of y'all told me that.
What we do, we work together.
Right, we work together. Yeah,
um,
we work. We work
right, we
together.
work
You
together.
know.
So we do a lot of employee benefits where we sell life insurance on the job site where the payment comes out the person's paycheck. But the reason why we do it that way because when the employee is paying for it, when the employee is paying for it, the employee owns the policy. So when the employee leaves, retire, relocate, change jobs, or even get fired, they take the policy with them. Remember, the policy that we're selling is whole life policies. We're selling so they're all building cash value. So the benefit of having the policy coming at your paycheck is pre-taxed. So the money that's going into this insurance policy is pre-taxed because it's coming out of your paycheck, right? That's another perk. But to answer your question, when the employer pays for the insurance, it's only while the employee is working there. So when the employee leaves the job, they no longer have life insurance. But if they buy it in the way that we sell it, which is voluntary life insurance, where we go to the employer and say, listen, I know you already offer your employee life insurance, but it's while they're working there. But we want to offer them insurance that they could purchase on their own, build their own cash value, have their own death benefit, have their own beneficiary.
So when they leave,
right, we want to offer that to your employees at no cost to you, which is the employer. So the employer says, well, I don't have to pay for this. No, you don't have to pay for this. All you have to do is take up the person's paycheck if they want the insurance. Now, what that's doing is when the employee leaves, the policy goes with them.
Right, which is important.
Right, so the policy that the employer is paying for is gone when the person leaves the job.
Right. But most jobs don't do that, though.
What?
They don't allow the people to take the insurance with them.
Well, if they're paying for it, then you can't take it with you.
Right, but
if
people don't know.
If the employer is paying for your life insurance, you cannot take the policy.
Did y'all hear that? Okay.
Sometimes you have employers that do they match. They'll match the payment of. We have clients like that where the employer would match what the employee is paying for their policy.
Okay.
But again, if the employer is paying for it, you do not take that part of the policy with you.
Okay.
You only take what you purchased.
What you purchased.
Right.
So that's important to know.
Yeah.
And it's so important to, even though you can get insured, different ages, okay, but it's important to get insurance. You start young if you can.
Yeah, the younger the better.
The younger the better.
Because it gives you more time for the cash value to grow.
Exactly. So for those of you who have insurance on your job, if your employer is paying for it, you need to look into it and see if you can, if you are allowed to take that when you leave.
Right.
I don't know. I don't think you can, but people like to check to see because if you cannot take it, then that means that you need to get some life insurance. Right. So that you don't have to be dealing with the GoFundMe.
Right.
Because that seems to be something that a lot of people depend on, and we want to come away from that. We want to help you to come away from that. Get yourself covered. Cover your assets. You are an asset.
I've been seeing some times, I'm just going to give this example real quick because nobody really talks about this. I've seen some times where the employee has a policy through their employer, right? But the employee maybe fell sick. They got sick.
Okay.
And now they're not working.
Okay.
And then they die.
Okay.
They weren't working at the time when they died, so therefore they're not entitled to the insurance that the employer has on the person.
Wow.
So again, that's why it's good for the employee to purchase their own policy, whether it's through their job or outside the job.
Wow.
You should have your own policy.
Wow.
Yeah. So now the kids are calling the employer like, well, my parents haven't, they worked for you for 20 years. They have any insurance? Well, when your parents passed away 2 months after they couldn't work, so technically I'm not responsible to pay the death claim.
Oh, I know.
Well,
wow.
Pay
the benefit, the death benefit.
Yeah. So that's something to also think about. That's not really talked about.
No, it's not. And this is why it's important for you to cover your assets. You are an asset. Make sure you get your own insurance. As you were talking, another thing that I want to bring up is that, and this happens a lot. You need to, for those of you who have insurance, married couples, because people get insurance for all type of situations, but you forget to change your beneficiaries after divorce
Right.
or once
Separation.
separation.
Yeah. I've seen a lot of times where,
Oh my God.
my client, I'm talking to her. I did a policy for her, and I said, well, why don't you get a policy on your husband? Oh, well, he already has a policy through his job. He already has a policy. Well, I've seen many times when the spouse passed away and the beneficiary was their first spouse or
I've
partner.
seen that. I've
So
seen
now the wife or the husband who's currently there is responsible to pay the death benefit, responsible to pay the funeral expenses, while the ex-wife is or ex-husband is receiving the death benefit because that person never changed their beneficiary.
I've seen that.
So
that's not cool.
It's definitely real. Like you gotta.
That's
check your
not
stuff.
cool. I can't even laugh at that one because I've seen that happen. I've seen it. And the ex-wife, no, you ain't entitled to that money. Why can't you just give it to the wife? I've seen that happen. So I'm asking all of you, check your beneficiaries, have your husbands, your wives, those who were previously married, check the beneficiaries. Get your house in order, your financial house. I mean, I'm not saying that, to be condescending or anything like that. I'm just saying, I'm trying to bring some enlightenment to, your finances, especially where we're basically focusing on insurance. But please make sure that you check your beneficiaries and make sure that all of that stuff is in order, because you have experienced it, and so have I, and it's not a laughing matter.
Yeah.
It's not a laughing matter, So now, what is a final expense insurance?
So final expense insurance is just enough coverage for death benefit purposes. So most final expense policies, it's for people who are age 50 to 80.
50 to 80.
We can, outside of New York, we can offer 40 to 80 outside of New York State, but New York State is 50 to 80.
New York is just terrible. But go ahead.
But so final expense is no health questions asked.
Mm-hmm.
No health questions asked. Again, it's just enough death benefit for the funeral expenses.
For some of you who may want
want funeral expenses. You're not trying to leave a bunch of money to anybody. You
just want
enough money for the funeral expenses. 5,000, 10,000, 15,000, 25,000. Most of the times, the maximum coverage for a final expense policy is like $35,000.
Okay.
So it's just enough.
That's just enough
for your final expenses, which is your funeral arrangements, any last minute bills that you don't want your family to have to pay, medical bills, things like that.
Mm-hmm.
So that's what the final expense plan is for.
Okay.
It's affordable though, because the death benefit is not so big.
It's not so big. Yeah, it's not
affordable. So expensive. So people may think it's expensive, but it's not expensive. It's very affordable.
Yeah.
I encourage people to buy that kind of policy because most of the time, you're elderly, you have health issues.
Exactly.
And you're on a fixed budget.
Exactly.
So I would recommend to my clients sometimes when
me too.
If that's the case, buy a final expense policy for $30-$40 a month.
Yeah.
And make sure your funeral expenses are covered.
Yep.
That way it's not the burden of somebody else to do. If you missed us from buying policies later, before that time period, because if you came across us years ago, you should have a whole life policy
for
$100,000 or more.
Right. Right.
That's just if you just need enough for death benefit expenses and last minute bills.
Yeah. Okay, so final expense. That is final expenses. If you happen to fall in that category, you can actually get final expense.
And sometimes people that's the only option for some people.
Yeah, that is
because of the health situation.
And they waited too late.
Yeah, the health.
Unfortunately,
the health may not be good, so that may be the only option they have to get coverage.
But but that's an option. So people, you can get covered.
Yeah, it's an option.
You can get covered.
Yeah, it's an option.
So I encourage you. I'm going to give all of my information out at the end. You can contact me and we can, help you get some coverage.
Because you're a licensed professional at this, so you
exactly.
I'm just here to help.
Exactly. So I appreciate you here to help me.
I'm just here to help. I'm here to support.
Oh my God. So can Can once somebody get a life insurance policy, can their payments increase?
Once you get a whole life policy, the price never changes unless you want more coverage. So with a whole life policy, the prices are all fixed.
They stay the
The
same.
prices never go up. But if you want more death benefit coverage, or if you want to add more to your cash value
Mm-hmm.
accumulation, that's when the price will go up. If you want to add more to the benefit, the benefit is what? The cash value and the death benefit. Those are what you're adding to when you increase your policy.
All right. So let me ask you this question. Somebody who um, has money,
Right.
you
Like
know,
money, like cash money, like in the
cash
bank.
money. Yeah.
In the bank. Okay.
They don't have no insurance, but they got cash.
Okay.
Um, well, because this could play a whole this could go different scenarios, but I'm just going to keep it general.
Mhm.
You got a lot of cash.
Mhm.
Do you think that person would still need life insurance?
Definitely. Definitely. Because again, you're taking that money from being taxed on every year and you're moving it to a whole life policy where it's not taxed on. And you still get access to that same amount of money the way we structure it.
Okay.
So if you have a,
So if I got $500,000 sitting in the bank right now,
I'll put the whole 500,000 into the whole life policy
okay,
and use that as your bank. So 50,000 of it can go to the premium of the whole life policy
to pay it up.
to pay it up, and then the other money could just be your bank. That's the money sitting in the policy where you can withdraw from as you wish. You take money out of it, you put money back in. Take money out of it, put it back in. That's now you're your own bank. So to a person who has 500,000 sitting around, they should put it into a whole life policy. The way we would structure it, they'll have access to that 500,000. Well, take 50,000 of it, pay that towards life insurance
because the 50,000 is going to do what? It's going to pay it up. They're never going to have to
Right.
pay on that policy
Right.
again.
Right. That's
Paying the policy up,
you bought the vehicle.
which is the policy.
Right. Right. The vehicle's holding. Let's say you bought the shelter.
The
Let's say
shelter.
that.
Okay.
You bought the shelter.
Okay.
Right.
Uh-huh.
The shelter's holding the money from the IRS. If someone wants to try to sue you, they can't sue you for that money because it's not considered liquid money. They see it as a death benefit, but you know that it's access to cash. It's cash that you can take from.
Okay.
So you want to have that vehicle to dump your money in and pull out when you wish. The idea to put the money back in so you use it again. That's your bank. Now you're your own bank. But the difference is the traditional banks you're being taxed on. You're being reported to the IRS on what you take out. With the whole life policy, you're not being reported to nobody. Nobody knows what you're doing.
Nobody don't know.
Except for the person on the phone, customer service. That's it. They're not gonna say nothing. You know.
So a lot of people that you do business with, a lot of wealthy people do that.
Yeah.
That's what they do.
Yeah, I mean,
they hide their money, right?
Yeah, most people who do that, they were born into that already. Like their parents taught them that. I mean, when they were born, they had a policy, and by the time they became 18, they had access to cash within their policy. I guess like McDonald's founders. So again, this is not on billboards. This information is not easy access.
They don't want us to know that.
You know, I mean,
they don't want us to know.
Yeah, I mean,
so they want to pay tax. They want us to pay taxes.
Well, they want you to buy the regular policy, the term policy. They want you to buy a term policy because they know you're gonna outlive it. So if I'm an insurance company, right, and I have 1 million people that have term policies and they're paying $50 a month for the next 30 years, and no one dies because we know in America they make more money with you being alive. Medication, doctor visits, it's all money, right? So we don't want nobody to die in America. We want people to live, right? We want people to live. We want to.
Nobody pump us up with
money. Right? You want to live. You want longevity. That's what I mean, who wants to die? No one wants to die.
Right.
So if I'm selling you term insurance and I'm an insurance company,
okay,
not a broker, not a joint agent, but an insurance company, I'm gonna always promote term insurance because I want you to buy term insurance because I want you to outlive it. But if you outlive it, I keep all that premium as an insurance company. Because what death benefit will I pay out?
Nothing.
Exactly. So now I kept all that premium, which means payment, and I'm reinvesting it. So now what do? I go buy stadiums. I'm just, but yeah, that's how it works.
Oh
go
my
buy
God.
basketball stadiums and football stadiums and put my name on them.
Well, you heard it. You heard it, y'all. You heard it.
That's how term insurance really works.
That's how it really
I mean,
works.
because people,
Because after 30 years, you have to
buy a new policy, and now the price is more
because they're basing it off of
your age, your current age at that time. So now you're 30 years older than you were. So whatever you're paying till about 30, that's the new payment. And let's hope you're in good health. If you're not in good health, then you might not even get the coverage. Well, they have it where you could do a
it's
conversion.
Yeah, but your conversion at that age,
right? So some
is
people,
more money.
So some people might
right?
challenge me and say, "Well, I have a term policy, but I can convert it in 30 years." Okay, you can convert it, but you'll be paying 30 times more than what you're paying if you would have bought a whole life policy today.
Right.
So eventually, you're gonna pay the whole life policy. Eventually, you're gonna pay the whole life price. Just you won't have a whole life product. You won't have access to cash. You won't have cash value accumulation. You won't have a guaranteed benefit for the rest of your life. You're gonna always have to keep getting a new policy at some point.
See, I have to as we flowing, I gotta write down my questions while he's talking because I know these are some of the questions that I get. I know these are some of the questions that people have, and I want you to get your questions answered. What do you say to somebody who said, "Well, why do I have to borrow my own money?" That's the number one question. I know you get it because I get it all the time. Why I gotta borrow my own money? It's my money.
Right. So any loan is not taxable. So if you borrow your own money, the IRS can't tax you on it. That's just a feature again, so you're not taxed on. So
well, help them understand. Wait a minute, what you say? Say that again, because so when they're 401k, they get taxed on that, don't they?
They get taxed on it because it's a form of liquid. They're not borrowing the money; they're withdrawing the money. It's like a bank account. You're withdrawing the money. You're withdrawing it.
Oh, okay.
So it's not a loan from it's not a loan from the bank. It's not a loan from the 401k. It's a withdrawal. It's
from the 401k.
For 401k.
That's why they got to pay and they penalize.
That's why they got to pay and they penalize, right? But when it comes to life insurance, yes, it's your money, but the way the policy is structured, again, tax shelter. The reason why it's structured that way because the IRS cannot tax you on a loan. But it's a loan. Yes, it's a loan against your own money, which is the way you want it to be that way. Because now, who you paying back? You paying back yourself whenever you feel like paying back yourself. And if you don't pay yourself back, then you want the death benefit when the person passes away. You want to pay yourself back so you can use the money later in life, of course.
Yes. Exactly.
Again, you want to use it as a bank. You want to be able to access money, use it, spend it, invest it, put the money back in, and do it again. Because the money that's sitting in the cash value is growing between 6 to 8% guaranteed.
Guaranteed.
6 to 8%. Most policies that we sell, between 6 to 8%, the interest rates are of growth in the policy, in the cash value of the policy.
Mm-hmm.
That's the growth.
And I know people now are like saying, what am I doing with my money? Because you got these wars going on. And I know people questioning, I was watching Bloomberg today and, that's all they were talking about is the markets. So, you really want to have your money in something that is guaranteed right now.
Yeah,
safe. Because it's about to go down, y'all. It's about to go down. Okay. How do somebody really determine how much coverage that they need? They look at the asset, I guess, right? How does
what they own, what they want to own. How much they make per year. Again, I always ask a client this: how much do you want to put away every month? That's the main question. How much money do you want to see later in life? How much can you afford to put away every month? $400, $100, $30. I don't know, whatever. How much can you afford and still be comfortable putting away?
Okay.
How much do you want to save? How much money you want to see later? How much money do you want to see later in life?
Mm-hmm.
You want to see 100,000 later in life? You want to see $1 million later in life? In cash, not death benefit. I'm talking about access to cash because the policy that we sell, your payment, premium, meaning payment, justifies what your cash value would be later in life. Death benefit is already there. We know that already. We're talking about the life part of life insurance, right? So, or the life part of whole life insurance. Let's be clear what kind of product we're talking about.
Yes.
We're talking about whole life insurance. We're not talking about terms. We're talking about whole life insurance. So, to answer your question, I was as a client, how much money do you want to save? And how much money do you want to see later in life? That's how we determine how much money they pay per month.
Okay.
Not even pay. How much money they're saving.
How much the money they're saving?
Because you're not really paying. You're really saving.
You're saving.
You're saving.
Yeah, you are saving. You
really use it later in life.
Right.
You're gonna use it. You're gonna use the money, and if you don't use it in life, you get it in debt.
No, they're not gonna get it.
I mean, well, they're not, but their kids or whoever they leave it
But your
to.
loved ones will get it.
Yeah.
You know.
Yeah.
It's something that definitely should be a part of your financial portfolio.
Yeah, definitely.
You know,
Definitely. It's needed. It's needed.
it is needed
It's needed.
with the understanding that it can be used other than
Just death benefit. It's not just death benefit.
right.
When it comes to whole life insurance, it's not just death benefit. Term insurance is just death benefit. Death benefit. Death benefit in a certain period of time.
Right.
You know?
Within a certain right.
Within a certain period of time.
With a certain period of time.
Like I said, a client comes to me that really wants term insurance. I mean, if they really want it, I still try to get them to buy a whole life policy with a term rider attached to it. But if they really want term insurance, I'll give them term insurance. But the reason why I do the whole life policy with term rider because when that term ends, they still have their whole life policy.
Okay.
And the benefit of having a term rider, the payment of that term policy is mixed in with the whole life policy. That's all mixed into the cash value.
Okay. Okay. So we here with the expert.
That's our strategies, you know. That's some of our
We giving strategies.
Yeah.
Pernod's giving us strategies, y'all. Here with the financial expert here, giving us strategies on. I call it wealth insurance. I'm calling it wealth insurance because it can be used as that. We just have to know the strategies. That's all.
I mean, you have to sit down with a trusted, financial, professional that's going to give you the honest truth, and give you a product that benefits you and not them.
Mm-hmm.
That's what it comes down to. It's life insurance is not just doing an application and applying for life insurance. There's so many moving parts.
Mm-hmm.
Who you sit with is important.
Mm-hmm.
Are they honest? Are they giving you the right information?
Mm-hmm.
Are you really getting the proper treatment?
That's right.
People tell me, I bought a policy for my cousin, but how long have your cousins been in business? Do they really know the ins and outs of insurance business? Do they really know?
Mm-hmm.
Do they really know what's best for you, what you're trying to accomplish?
Mm-hmm.
I'm all about supporting family, but if you're gonna buy a policy, you must
take
trust in take it serious, but also the person must be trustful that's giving it to you, and they must know what they're doing.
Yeah, because it's not just
must know what they're doing. They must know what they're doing.
Yeah, that's true. That's true. I agree 100%.
I mean, when you're dead, you can't change anything. I'm just kidding. I come to people all the time. I'm Pernod Dunston. I do life insurance. Or I got life insurance. Okay, you already got life insurance. Okay, cool, no problem. How much coverage do you have? I don't know. What kind of policy do you have? I don't know. What's the name of the company? I don't know. So if you die tomorrow, what's gonna happen? If you don't know, nobody else knows, I'm sure. Because you didn't tell nobody what you have because you don't know. So, you gotta know this type of stuff, But I get it though. Nobody wants to talk about death, so I get it.
Nobody wants to talk
I get it. But you have to just do it.
Yeah, nobody wants to talk about it.
That's
because they only consider it to be they connect it to death. Mm-hmm. And it don't have to be connected to death. When you putting strategies around it, it can be used for you in life while you are living. And that's the reason why we're bringing this series, because we want to, enlighten you, open up the eyes of your understanding when it comes to insurance.
Right.
Okay, insurance. And and it's about that time that we're gonna have to say goodbye.
Until next time.
Until next time. This is the time that we're gonna have to say goodbye. But before we go, I just want to give you an opportunity to reach out. If you have any questions, you can always give me a call, 718-412. You call the office, 718-412-5175. Okay, you can always we'll be on once a week.
I'll say one more time just in case.
Yeah, we'll be on once a week. Yeah, 718 is the telephone number. 412-5175, 718-412-5175. And we are also on YouTube. We're on Twitch TV. We're on LinkedIn. This is going live right now, and on Instagram. We're going live across all these platforms because we can. And number one, I want to really want to get, help people to understand, the benefits of life insurance. like I said, we were both just saying this. People don't like to talk about it. That's because they, number one, they don't understand it,
I mean, it's scary too. I mean,
and it's
yeah,
scary
it's
because
scary.
they
you
don't
know?
they don't want to talk about nobody benefiting
Yeah.
off of them,
Yeah, it's scary.
right?
No one talk about death. You know, it's scary. Yeah,
And
it
then
is, it
especially
is,
off
it is.
of you, like if you or me, you're talking about something that I'm leaving behind for somebody else to enjoy. But we're letting you know that no, it don't have to be like that. You can enjoy the benefits of it.
Right.
So this is part two. If you didn't see part one, I recommend that you go back and see part one. But this is part two of the wealth series, the wealth series. We're wrapping wealth around life insurance because we can. And we're just showing you what strategies that you can use, you know, in your financial portfolio to strengthen it, to help you make better decisions to increase your quality of life for you and your family.
Yeah.
Right. So we'll be on, uh, just listen, my social media handles is at make sense with your money. No, I'm sorry, make sense with money. That's my social media handle. Make sense with money. And you can follow me across all. I'm on all TikTok. I'm on all of them. So when we come on, you'll be able to once a week. You'll be able to and we're on Wednesdays. So you'll be able to get this information and share it. Share this so that other people can have an opportunity to be blessed as well, because this is a blessing. All right. So thank you so much for tuning in. Like I said, you can give us a call. Give me a call, 718-412-5175 with any questions. And also if you need some coverage. So until next time, I'll see you next week.